This isn't a silver panic. It's a policy clock hitting zero, and the market is repricing the metal before the rules change overnight. The headlines want you to believe this is just end-of-year chaos, profit-taking, or a bubble finally popping. And that's convenient because it keeps you watching the wrong screen. The real fight isn't happening in the price you're staring at. It's happening in the plumbing underneath it. And the part most people missed is simple. When a calendar date threatens to put friction into physical supply, the physical market doesn't debate it. It front-runs it, quietly, aggressively. Then the paper market is forced to reconcile that demand with thin liquidity and crowded positioning. And that's where the real pressure starts. Because if one level breaks, the math changes. Not the narrative, the math. Here was the payoff you are going to get by the end of this video. The one signal that tells you whether this move is just noise or the early stage of a structural squeeze that can reprice silver again in the next 1 to 2 weeks. Even if the tape looks violent and irrational on the way there. And yes, we're going to talk levels, triggers, and exactly what would invalidate the whole thesis, because that's what separates a tradable map from a hype story. Now, let's deal with what you're feeling right now when you watch the silver chart. It doesn't look like a trend. It looks like a machine that's throwing people off at high speed. Big green candles, sudden air pockets, snapback rallies. Then another slap. That's not an accident. That's what happens when you combine 3 ingredients: a year-turn liquidity gap, policy-driven urgency in the physical chain, and leverage that got comfortable after a historic run. Add one more ingredient, and you get the chaos units are seeing. Exchanges tightening collateral requirements right when volatility is already elevated. That one detail turns ordinary pullbacks into forced selling, and ordinary rallies into forced buying. But that's not the part that matters. The part that matters is why the market is doing this right now, in the final hours of the year, with January 1st staring everyone in the face. Because policy dates create a different kind of buyer. They don't buy because they're bullish. They buy because not buying creates operational risk. That is a completely different animal, and it doesn't care about your chart patterns. Think about what a tariff or export control style shift really is in practice. It's not a philosophical debate about trade. It's a wedge that changes who can ship, who can receive what paperwork is required, how long it takes, and how much inventory a manufacturer must hold to avoid being the one factory line that stops, because metal didn't clear in time. The moment a wedge appears, 2 things happen. First, buyers pull demand forward. They place orders early. They pay up for certainty. Second, intermediaries widen spreads because uncertainty has a price. That combination, pulled forward demand and wider spreads, shows up before the headline shows up in the price that retail sees. The market always whispers before it screams. And in silver, the whisper isn't in the spot print. It's in the spread. It's in the premium. It's in the curve. It's in the way deliverable metal behaves when paper claims multiply. Everyone's staring at the loudest number on the screen. Meanwhile, the signal is somewhere else. Starting January 1st, the silver world is staring at a new rule set tied to export licensing and tighter control over refined flows out of a major processing hub. Call it a tariff shift. Call it a licensing regime. Call it administrative friction. It doesn't matter what you label it. The mechanism is the same. A large share of refined exports that used to move with ordinary commercial rhythm now moves with permission, paperwork, and prioritization. And that changes delivery timing. It changed reliability. It changed inventory strategy. It changed the willingness of suppliers to promise dates. It changes everything that industrial buyers actually care about. And when the industrial side starts caring, the silver is just a shiny thing crowd gets blindsided, because silver is not just a precious metal. It's a hybrid. Half macro, half industrial, with a speculative tail. That hybrid nature is why silver can feel like a calm inflation hedge 1 month, then behave like a leveraged momentum asset the next. And right now, the industrial side has a reason to move first. And that's why the next detail flips the whole setup. Silver supply doesn't ready respond quickly to price. Not in the way people assume. A big portion of silver comes as a byproduct of mining other metals. That means higher silver prices don't magically turn on a flood of new silver output next week. Even if the price screams, the supply chain answers in slow motion. Mine plans, refining capacity, contracts, logistics, all of it. The market can swing wildly on the margin because the margin is where the stress lives. And policy friction compresses that margin. So what does this look like in market structure terms? It looks like a spread that starts telling the truth. The spot quote can look normal, while the cost of obtaining actual metal, deliverable metal, on time, in the right form, in the right place, starts to detach. That detachment can show up as unusual premiums in regions where demand is urgent. It can show up as backwardation, where near-term prices are higher than later prices because the market is paying you to deliver now, not later. It can show up as elevated lease rates, where borrowing metal costs more because metal is harder to source without paying up. It can show up as exchange for physical style tension, where paper and physical pricing need a bridge, and that bridge gets expensive when everyone tries to cross it once. And that's the hidden detail you need to anchor on. The price is noisy, but the spread is honest. If spreads are tightening the physical market while the chart is whipping around, the move is not just emotion. It's math. Here's the conflict you're watching play out in real time. The paper market wants to treat this as a tradable mania. Chase, dump, rebuy, and clip volatility. The physical market wants one thing: certainty of supply in a window where the rules are changing. Those two markets meet inside the futures complex, and when they collide during thin liquidity, the tape looks like a panic. But it's not panic, it's constraint. It's participants being forced to do things. And if you understand what they're forced to do, you stop being the liquidity they feed on. Now let's make it concrete without turning this into an academic lecture. Silver S recent action has been defined by a simple psychological line: the big, round number handle around 70. That's not magic. That's where human brains anchor, where options strikes cluster, where risk managers start changing their tone, where margin models start tightening, and where a lot of, and I'll buy it if it dips. People finally show their hand. Above that line, the market is telling you silver has crossed from interesting into regime. Below that line, the market is telling you momentum can be shaken out and leverage can be punished, even if the long-term thesis is intact. And that S, exactly what you have been watching. Violent moves around that zone because it S where positioning flips from voluntary to forced. If silver rips, short gamma participants and short futures participants have to buy to reduce risk. If silver dumps, leveraged longs have to sell to meet calls, and the selling can cascade in seconds. Same thesis, different participants, different forced actions. That is why you can be right and still get wrecked if you mistake noise for signal. But there's a way to read through the noise, and it starts with the term structure. When the front end tightens, it's not just a fun trivia fact. It forces behavior. Backwardation, even mild, is the market paying a premium for immediacy. It says, I need it now. That can be driven by real demand, by fear of policy friction, by localized shortages, or by an inventory preference shift. In any case, it matters because it pressures shorts and it rewards holders of near-term metal. If your short paper and the curve says deliver now, you have a problem. If you're a manufacturer and you see that curve, you don't wait, you secure. And once buyers start securing, the system becomes reflexive. The buying tightens the curve, the tightening curve justifies more buying, and the paper market scrambles to hedge. That's the reflexivity that people call a silver squeeze when it gets loud. But it starts quietly. And the next detail is what makes January 1st so explosive. Policy friction doesn't need to remove supply to tighten the market. It only needs to slow it. A licensing step, a documentation delay, a prioritization regime, those are time bombs because industry runs on timing. If shipments that used to clear in a predictable cadence now clear with uncertainty, every prudent buyer increases buffer inventory. That's not speculation, that's operational survival. And even a small increase in buffer demand can pull forward a meaningful amount of physical buying because the market is not swimming in instantly available deliverable silver. A lot of inventory exists in the world, but not all of it is for sale, and not all of it can be mobilized quickly, and not all of it is in the right form for the right buyer. This is where most commentary goes wrong, because people look at inventory like it's one number. It isn't. There's inventory that's deliverable. There's inventory that's registered for delivery. There's inventory that is eligible but not offered. There's inventory that sits where it doesn't help the buyer who needs it. There's inventory tied up in long-term contracts. There's inventory sitting in products, panels, electronics that cannot be recycled on a 2-week timeline. So when you hear someone say, there's plenty of silver, ask a sharper question. Plenty of what kind, deliverable where, and on what timeline? Because if the question is deliverable in the right place, in the right bar spec, in the right window, the answer can change fast. And that's where the real pressure starts. Now layer in global arbitrage, because this is the second engine that makes the move look bigger than it should be. When one region pays up for silver, arbitrage normally pulls metal toward that premium. That's the market balancing itself. But policy friction acts like sand in the gears. It slows the pull, it raises the cost, it widens the spread. If a major processor adds export licensing and tighter control, that doesn't just affect exports from that country. It affects global trade routes, because it changes who becomes the marginal supplier. It changes who sets the premium. It changes where inventory gets hoarded. It changes the bargaining power of refiners and wholesalers. And if the premium is in Asia while the benchmark futures are priced elsewhere, you can get a persistent gap that forces adjustments in hedging and procurement. That gap is the market screaming in a language most people don't speak. And if you can learn to hear it, you'll stop reacting to every headline candle. Here's what that looks like in practice. You'll see physical quotes in certain hubs holding stronger than the futures print, or decoupling in a way that forces a repricing of the convenience of metal. You'll see reports of delivery delays extending. You'll see wholesalers becoming less willing to lock pricing for forward delivery. You'll see premiums widen on common products. You'll see lease and borrowing costs rise because metal is in demand for real use, not just exposure. You'll see the curve kink. You'll see the paper market whip around because it's trying to price a physical reality that is moving under its feet. That is not a guarantee of higher price tomorrow, but it is evidence of a tightening setup. And that's the distinction you must hold in your mind. A tightening setup can still produce brutal pullbacks. It can even produce a waterfall drop. Why? Because leverage doesn't die gracefully. Leverage dies violently. The market can be fundamentally tight and still smash price in the short run because margin calls don't have to negotiate with your thesis. They demand cash. And when exchanges raise margin requirements into volatility, you get an accelerant. People who were long with leverage are forced to reduce. Not because they changed their mind, but because the rules changed and their collateral wasn't sized for the new reality. That is why you see these sudden plunges that look like the story is over, followed by snapback rallies that look like, never mind. The story didn't change. The positioning did. And that's the part that matters. Now we need to talk about the options layer, because this is the third engine that can turn a normal policy-driven repricing into a short-term price teleport. When silver trades near big option strikes, especially round numbers and recently defended levels, dealer hedging can become reflexive. Here's the simple version. Options have delta, which measures how much the option behaves like the underlying. Dealers who sell options often hedge that delta by buying or selling the underlying. When price moves, delta changes. That change is gamma. If the market moves into a zone where gamma is large, hedging flows intensify. That means price movement can generate hedging, and hedging can generate more price movement. Now that's not a conspiracy. It's mechanical risk management. In a low liquidity environment, those hedging flows can dominate. That's why you can see silver rip through levels that should matter, then stall abruptly, then reverse, because the hedging flow changed sign or finished. It's why certain strikes act like magnets, then slingshots. It's why the tape can feel like it has a mind of its own. It doesn't. It has a hedging model. And if you're watching the chart without respecting the options layer, you're playing chess while the other side is playing physics. But that's not the part that matters. The part that matters is what these mechanics force participants to do right now, this week, into the year turn and the policy date. Funds are closing books. Risk managers are tightening limits. Liquidity providers are less willing to stand in front of fast markets. Industrial buyers are pulling demand forward. Paper traders are leaning the wrong way at the wrong moment because the chart invited them to. And when too many people lean the same way in silver, it doesn't drift, it snaps. So let's stack the proof, because one argument is never enough. First proof layer is the calendar itself. Year-end isn't just a date, it's a liquidity regime. Thin holiday trade means fewer natural counterparties, wider spreads, and sharper moves for the same order size. Second proof layer is exchange tightening. When collateral requirements rise, leverage participation shrinks abruptly, and that causes forced liquidation on dips and thinner offers on rallies. Third proof layer is physical versus paper tension. When policy friction arrives, physical premiums and deliverability concerns tend to show up even when the spot quote is bouncing around. Because the physical buyer isn't trading candles, they're buying certainty. Fourth proof layer is term structure. Any front-end tightness, any kink, any sign that immediacy is being priced supports the idea that the market is paying for now, not later. Fifth proof layer is global arbitrage gaps. If one region holds higher relative value for physical metal, that implies constraints in moving supply to meet demand, which is exactly what licensing or tariffs create. Sixth proof layer is positioning behavior. Sharp dumps followed by fast rebounds are classic signs of leverage flushes and forced cover, not just the bull is dead. Seventh proof layer is the macro overlay. Silver lives at the intersection of currency, rates, and risk appetite. If the dollar strengthens and bursts or yield shift, silver can whip. But persistent physical tightness can still keep the floor higher than people expect. That's a lot of layers, and that's the point. You don't need every layer to be true at maximum strength. You need enough layers to make the behavior coherent, because coherence is what creates trust. Now, I'm going to give you the hidden detail in a way that you can actually use. Stop asking, is silver going up? Start asking, is the market paying for immediacy? Because immediacy is the one thing policy friction attacks. Immediacy shows up in near-term spreads, in backwardation signals, in physical premiums, and in the difference between what a chart suggests and what the real supply chain is doing. If the market is paying for immediacy while price is volatile, it suggests the move is not purely speculative. It suggests real demand or real constraint is participating. If the market is not paying for immediacy, if the curve relaxes, premiums compress, lease costs fall, then the move is more likely a momentum episode, and the chart can deflate harder than you expect. That's the tell. That's the metric everyone must watch. And now we can talk about the next 1 to 2 weeks like adults, with scenarios, levels, and invalidation. Scenario 1 is the controlled pullback and retest. In this scenario, silver shakes out leverage, retests the breakout shelf near that 70 handle, maybe wicks below it briefly to trigger stops and force weak hands out, then reclaims it with authority. If that happens while the spread signals remain firm, meaning physical and near-term tightness doesn't evaporate, that retest becomes a reload, not a failure. And if it reloads, the next upside objective is simple. Revisit the recent highs in the upper 70s, because that S where the market last found resistance and where call hedging dynamics can become reflexive again. That's the controlled path. It's still volatile. It still punishes impatience, but it gives you structure. Scenario 2 is the continuation, squeeze, and gap risk. In this scenario, the market doesn't give you a clean retest. Liquidity stays thin, policy fear tightens physical behavior, and any dip gets bought faster than expected. Shorts who were comfortable start to feel pain, and instead of adding, they cover. That cover becomes fuel. Dealers hedge calls into rising price. The curve tightens, premiums persist, and silver can rip into the high 70s and even flirt with the 80 zone again in a very short window. This is the path where you wake up to a gap and realize the market moved without you, because the market was never obligated to give you a perfect entry. That's the uncomfortable truth. And this is where risk management becomes the whole game, because scenario 2 is also where the market will use volatility against you. It will pump, then dump, then pump again, daring you to chase. It will flash red, then green, making you feel stupid either way. And that's by design. Volatility is the market's extraction tool. Now, what would weaken this thesis? What's the invalidation? First, a sustained failure to hold that 70 handle, not a wick, not a panic spike, but a real breakdown where silver trades below and cannot reclaim it in short order. That suggests the breakout shelf failed and the market is re-rating the move as a blow-off rather than a new regime. Second, compression in the physical signals. If the premiums that implied urgency suddenly compress, if the curve relaxes, if immediacy stops being priced, that suggests policy fear was priced in and then diffused, or demand pulled forward and then went quiet. Third, a macro shock that tightens financial conditions in a way that forces broad deleveraging, because silver can get sold with everything else in a true liquidity event. In that world, even a tight physical market can be overwhelmed short term, and that's why you must separate trend signal from noise. Trend signal is the structure holding above key shelves, supported by physical and term structure behavior. Noise is the violent candle that exists to clean out leverage. The market will try to get you to confuse them. Don't let it. Here's how the emotional manipulation works, so you can recognize it while it's happening. First, the market makes a dramatic move that triggers fear of missing out. You feel urgency, you want in. Then it slams down hard, not necessarily because the thesis changed, but because it needed to flush weak leverage and reset positioning. You feel fear, you want out. Then it bounces violently, making you feel regret if you sold, or panic if you didn't buy. You start acting to relieve emotion, not to follow a plan. And once you start acting for emotional relief, the market owns you. The psychology shield is simple, but not easy. Decide your time horizon before you watch the next candle. Decide what level matters for your thesis, like the breakout shelf around 70, and decide what evidence would confirm or weaken the setup, like persistent tightness in near-term spreads and physical premiums. Then size your exposure so that you can survive volatility without being forced to act. Because forced action is where losses compound. If you're so leveraged that a normal silver move can liquidate you, you're not investing, you're renting a position from the broker. And the broker collects rent in volatility. The market can whip around violently, even if the thesis is correct. That's not a disclaimer. That's the core lesson of silver. It is designed to be uncomfortable. So what do you watch next, practically, in the coming days, without drowning in noise? Watch the 70 handle like it's a referendum. Above it, the market is defending the regime shift. Below it, the market is testing whether the breakout was real. Watch the speed of dips. If dips get bought instantly and rallies hold, that suggests demand is not just speculative, it's urgent. Watch whether price action is accompanied by signs of immediate tightness, curve behavior, regional premiums, the language of availability. Watch whether margin tightening and year-turn flows continue to force liquidation, because if they do, you can get one more ugly flush that looks like failure but is actually a reset. Watch whether the market starts respecting higher lows. Watch whether silver can reclaim mid-70s after any dip. And watch whether the upper 70s zone becomes the battleground again, because if it does, the options layer can add fuel quickly. And here's the key. Don't watch headlines as your primary driver. Headlines arrive late. Structure and plumbing move first. The biggest trap right now is thinking you have to choose between panic and all clear. That's not how this works. This is a two-speed market. The physical chain moves with calendar urgency. The paper market moves with positioning and leverage. When those two speeds clash, the tape looks insane, but it's readable if you focus on what forces participants to act. Industrial buyers will keep pulling forward if they fear disruption. Dealers will keep hedging if options exposure demands it. Shorts will keep covering if the market won't give them relief. Leverage longs will keep getting shaken out if collateral rules tighten. None of that requires a conspiracy. It requires incentives, and incentives are the real engine of markets. So here's the clean way to think about January 1st. It is not that the world runs out of silver on January 1st. It is that the friction cost of moving silver can change on January 1st, and markets done T-wait for the world to run out. Markets price the marginal change in availability and timing. Timing is everything. If timing worsens, buffers rise. If buffers rise, near-term demand rises. If near-term demand rises, spreads tighten. If spreads tighten, shorts feel it. If shorts feel it, covering starts. If covering starts, the chart starts printing candles that look like panic. That's the chain. That's the math. And once you see the chain, you stop being hypnotized by the candle color. Now let me be blunt about what most people will do wrong in the next week. They will see one ugly day and declare the whole bull move dead. Or they will see one explosive day and declare 100 is inevitable. Both are emotional stories. Neither is a plan. Your plan is two scenarios: controlled retest or continuation squeeze. Your plan is levels. The breakout shelf near 70, the mid-70s pivot zone, the upper 70s resistance band, and the round number 80 area where psychology and options can collide. Your plan is evidence, immediacy pricing, physical behavior, curve behavior. And your plan is invalidation, sustained failure to reclaim key shelves and a deflation in the tightness signals. If you have that, you can watch this market without donating to it. And here is the subtle truth that will make you money and understanding even if you never touch a trade. Volatility is not the enemy. Volatility is the cover. It's the camouflage the market uses to hide structural repricing. It makes real moves feel random, so people dismiss them, sell into them, or chase them late. The institutions that survive don't need to predict every candle. They need to understand who is forced to act and when. That's why the calendar matters. That's why policy friction matters. That's why the spread matters. And that's why this January 1st shift is not just a headline, it's a catalyst for behavior. One more thing before we close, because it's important for trust. There are real counterpoints here, and you should respect them. Policy shifts can be implemented in ways that are less restrictive than feared. Licenses can be granted smoothly. Trade can adapt. Substitution can happen over time. Demand can cool if global growth slows. Macro can shift if the dollar strengthens or rates rise unexpectedly. And a market that has already made a historic run can absolutely correct deeper than people think, because late cycle momentum always feels invincible until it doesn't. That's not bearish, that's reality. The way you respect that reality is by not promising guaranteed outcomes, by not betting the farm, and by not confusing a long-term supply narrative with a short-term price path. Silver can be structurally tight and still dump hard on the way up. If you can't emotionally tolerate that, you shouldn't size up just because the story is exciting. That is how people get wiped out right before the move resumes. And that is the final revelation you need to hear. The market doesn't punish people for being wrong. It punishes people for being fragile. It punishes people whose sizing forces them to make decisions at the worst possible moment. Build a plan that makes you unpunishable. That's the real edge. If you're the kind of investor who wants a map instead of a dopamine hit, stay close to the signals and stay skeptical of your own emotion. Watch whether the market keeps paying for immediacy into the first full trading week of January. Watch whether 70 holds as a regime line. Watch whether dips are bought with speed instead of hesitation. Watch whether upper 70s becomes the battleground again. And watch whether volatility tries to bait you into becoming the liquidity someone else needs. If you can do that, you're not just watching silver. You're reading the market like a professional. And if you want more of these no-hype mechanism first breakdowns, where we identify the level that matters, the evidence that confirms, and the condition that kills the thesis, then you already know what kind of crowd this is. The people who don't get played by candles, the people who build a map and let the market prove it.